Hello everyone, welcome to our weekly market analysis session for August 1. My name is Carl Capolingua. I'm the market analyst over here at ThinkMarkets Australia, and it is a pleasure to be joining you for our wrap of the week and look to the week ahead. Let's kick off with cryptocurrency markets. Another solid week for the major cryptos on screen, really rounding out now about 4 weeks of recovery from what has been a rather severe cryptocurrency winter. Binance Coin, leader of the pack there. Many of those exchange tokens and DEXs doing well. I'm thinking of FTT, which is the FTX token, Uniswap, SushiSwap, all looking pretty good. Worth a look. Comparatively, the majors there, Bitcoin and Ethereum, was somewhere between sort of 5 and 6% gains. And then the laggards, Avalanche, interestingly lagging, one of those tier 1 DeFi protocols, but a theme in terms of the meme coins also lagging. So potentially keeping with this narrative of this crypto winter shaking out a lot of the fluff in the market. In terms of the fear and greed index, well, we're up to 39. That's a pretty decent recovery from last week's 30, but down from yesterday's 42. And I suspect when the new update comes out for August 1, it will be down again because cryptocurrencies, as they reserve the right to do, reversing course from everything we've just talked about, down about anywhere between sort of 2 and 3% on those majors. Talking about the majors, let's have a look at the technical analysis for Bitcoin. Not a lot out there on the news front for Bitcoin, a bit on Ethereum, we'll talk about that next, but Bitcoin really trading in a very tight trading range now between the 17,585 swing low from mid-June and the 25,366 swing low from May. As long as we continue to compress within this range, I can't see any reason to get too excited. A close above, not just a tickle, but a close above 25,366, I think is crucial to get that FOMO, get that enthusiasm coming back in. We could see a push back into the high 20s. And then look, let's see where we go from there. There's no point talking about anything better. We are still in a very well-established long-term downtrend, as you can see from this dark pink zone, and we still have to be thinking about selling the rally rather than buying the dips in the more medium to long term. Obviously, a break below 17,585 and all hell will no doubt break loose to the downside. Ethereum looking way better. We have far improved price action compared to Bitcoin in that we're not so much compressing within those swing low to swing low ranges. In this case, it's 880 to 1700. We're actually close to above 1700. I think that really is crucially important. The size of the rallies are better. The size of the pullbacks are far narrower. That's important. We're moving into this short-term uptrend. We're holding it with some really nice candles as well. Yes, we're getting a little bit of a pullback here, but as long as the control stays with these white candles and the demand case, as long as we don't push too far back into some of these potential demand zones, for example, around 1600, kick in some nice lower shadows, we could well move up into 2016. So could get a 2-handle here and some interaction with that long-term downtrend zone. Certainly not out of the woods yet or out of the crypto winter, but a far better backdrop, certainly technically for Ethereum. In terms of the fundamentals, of course, we've got that Ethereum merge potentially coming up mid-September. Those dates never tend to go to schedule, so I wouldn't pay too much attention to that. Look, hopefully somewhere in the next couple of months is the order of magnitude, and just this idea that we're going to move from proof of work to proof of stake. You want to get your 32 Ether stacked away to earn your validator rewards. This idea that that could suck a lot of supply out of the system and then therefore improve the demand supply dynamics for Ethereum, facilitating price increase. Look, as long as there's a narrative, often in crypto, that's all we need for some positive price movement, and that's at least what we have here. Let's head over to stocks now. A massive week. I mean, look at that NASDAQ composite up 4.7%. It is the poster child now for risk on, but the S&P 500 also had a massive week as well, up 4.3%. For such a a blue chip index, that cannot be understated, the importance of that. And then even the Dow Jones joining the party there, up 3%. Europe got a bit of a boost as well on the back of those US moves. Asia missed out. That's very interesting. We had the IMF come out during the week and downgrade global growth expectations for the coming 12 months, especially the Asia Pacific region, and then again especially for China. So the IMF expecting Chinese growth now to come in at 3.3%, which is the lowest it's been since 1976. So potentially Asia missing out on some of those growth concerns. talk a bit more about that later. For now, just note that volatility continues to come down. You can see just this series of black candles and upper shadows, and if it was a stock, you would be shorting that on that basis. Still not at the lowest level for this year, but creeping towards it. Having a look now at the technicals for the S&P 500, what a fantastic move, really. I mean, if you look at the price action, and when I mean price action, I mean peaks and troughs, and more importantly, the location of troughs to second from last peaks. This idea that when we pull back, we're pulling back to a previous area of supply, hopefully now acting as demand. We're seeing that. So when I say last trough and I say second from last peak, you can see here the interaction between 39.10 and 39.19. Yeah, we pipped it a little bit, but you can see the reaction off that. So really, really solid buy the dip FOMO price action here on the S&P 500. It looks amazing. Wonderful candles as well. However, and there's generally however in these equations, 41.78 key static supply point to the upside. We know a bunch of investors went long up here. We can see the price action, a lot of hope instilled into that area, and potentially this represents a break-even point for them. They suffered through all of this phase, and some of them might want to get out at that level. We've also got that long-term downtrend zone. We know that on the way up, you can see it tends to support prices. On the way down, it tends to resist prices. So it'll be interesting to see this week, crucial week, what happens around that 4,200 level. My tip is that we get at least a bit of a pause around here to consolidate those gains. At the worst case, we could get a bunch of black candles in here and actually push back down into some of those lower retracement levels. NASDAQ looks very similar. Won't spend too much time on this. It is great to see that we did get that close above 12,320. Great if you're a bull. However, if you're a bear, it's horrific. We are experiencing similar themes here. So interaction with the long-term downtrend zone. It was so good at supporting prices on the way up. It will probably resist prices on the way down. But other than that, the price action is pretty solid. Not as good as S&P 500, but some decent candles in there. Something I do note, particularly here on the NASDAQ, but also just flick back on the S&P 500. Look, volume is not spectacular. Ideally, you'd probably want to see a bit more volume here to tell us that we are removing some of that overhead supply, that demand is strong, obviously reflected by those candles. Whilst demand is there, we know demand's in the system. That's the white candles, that's the price action. There's not a great deal of volume there. So that demand is pushing into a supply vacuum. So the supply side is happy to wait for higher prices to back off, maybe potentially looking to come in at a higher level. Maybe it's just a reflection of the general uncertainty out there, as people just not knowing which way the global economy is going to go, interest rates, inflation, etc., etc. So interesting to see that. We will want to see the price action when that volume does hit. So if we get that huge influx in volume, is it creating black candles in the system, or is it creating white candles in the system? But we'll get that next chapter when it appears on the charts. Flicking over to commodities now. Look, again, another fantastic week. I'm going to be a broken record on all asset classes, because it wasn't just stocks. It was commodities, it was bonds, it was risk-off stuff, even like gold that went up. Having said that, look, tin and lead missed out, very sad. But the gains in copper up 8%. That's Dr. Copper. A little bit of fundamental news during the week. So we had Codelco, world's largest copper producer, noting about a 10% decrease in their quarterly production, mainly continuing COVID issues there. So it does show that some of these themes that predated this recent sell-off on global growth concerns are still around, potentially restricted supply as well. The problem is for a lot of these base metals before this week was that the fear was that demand would fall away much further because of the slowing growth picture than some of these supply constraints. But some of those supply constraints rearing their head again during the week. Other than that, IronOre 13% in China. That is not a misprint. That is a real number there, and 11.5% in the US dollar-based Singapore price. You can see chart on screen. A solid rally there. 1, 2, 3, 4, 5, bullish candles, either white candles or lower shadows in a row. A little bit of a pullback on Thursday and Friday. That was mainly to do with improving steel margins in China on the back of the Chinese government announcing a package of loans to kickstart some of these stalled property projects, and the real estate sector in China, a significant consumer of iron ore. So that helped here. Having said that, we've seen packages like this launched in the past that didn't have a huge impact, and perhaps also that IMF downgrade telling you where many analysts are expecting the Chinese economy to go, including Goldman Sachs. They had a report out during the week which was quite bearish on the property market in particular, and therefore drawing the line out to lower iron ore prices, so predicting sub $100 prices in the not too distant future. Overall trend here still, I would suggest to you, on the downside, but that is a rally, with some candles and a little bit of volume towards the end there that shouldn't be ignored. So we're getting this state of flux at the moment, isn't it? And reflected here in the copper chart as well, that V-shaped rally where you can't really commit one way or the other. It's tough for trend followers like me, because I would have called that a downtrend, and yet you get this big rally. So when the trends aren't there and when the going gets tough, I do find the best thing to do is to sit on your hands and wait for a clearer direction within the market. And often we think that to make money in markets, we need to be trading. Okay, we need to find the best trading opportunities all the time. Well, sometimes they're not there. And sometimes the best way to make money in the market is to not lose money in the market, and that is to stay out when things are as uncertain and as unclear as they are here. Nickel price getting a rally, but nowhere as good as, say, copper and iron ore. Gold getting a bit of a rally also here, and again, one of those risk-off assets. US dollar coming off. I think that's helping gold as well, and some of those long-term interest rates also coming off. Gold doesn't have a yield, so it tends to suffer in a rising interest rate environment. I'm not too excited about gold. I personally, for me, there's no trades there. It's still very much flat. If you look at, let me go back. If you look at where it is now compared to the start of that period, which is over 12 months ago, it is essentially the same price. So why would you bother trying to trade in a market that will just chop you up? I think the crude oil market's getting that way as well. It's pretty much where it was pre-invasion, just about now. I do think the short-term trend has decisively switched to the downside. Decisively means I think it probably will change the long-term trend in the not-too-distant future, and we'll actually see lower crude prices, then higher crude prices might help the global inflation outlook. You never know. Is showing a weekly gain there, which, well, maybe depending on the last 5 candles, I shouldn't doubt my data. I'm pretty sure it's right. Coming off a bit of a low base is probably what I wanted to say. As is the Australian dollar, 0.9% bounce as the US dollar weakened more broadly. The biggest moves on screen clearly down here in the bond market, as in massive falls in yields. Okay, so bonds rallying. Remember, there's an inverse relationship between bond prices and bond yields. So when we see this chart go down, that's Australian 10-year government yields, we are seeing bonds rallying. So interesting to see stocks and bonds rallying at the same time. Normally doesn't happen, but having said that, they both went down at the same time earlier in the year, isn't it? So that's not normal either. It's just highlighting how abnormal some of these moves are. Now, why are interest rates going down? Here, we keep hearing all of this rhetoric about interest rates going up. Well, they did go up. Okay, they did go up. And they went up so fast and so far. I mean, a move here from 1.6 to over 4%, nearly 4.2%. I mean, incredible gains, unprecedented types of moves in interest rate markets to catch up from those ultra-low stimulatory platforms that central banks were running to this more hawkish tone as inflation went bananas. Literally bananas, going up to, well, we should say lettuce, isn't it? Inflation went lettuce this time around. But they've gone up so far that the theory now is that these interest rate increases are starting to break the economy. And when the economy is broken, central banks don't increase rates, they decrease rates. And that's what you're seeing towards the end there. So we've reached this inflection point where rates have gone too far to break the economy. US yields reflecting that, also coming down well below now, 3% at 2.6%. So it will impact potentially some central bank decisions. Nice little segue into this. And we are seeing, I think, based upon some of these bond market moves and the caution in those markets, it's causing the Federal Reserve to, I guess, soften some of their rhetoric now. And we can see that when they did increase rates during the week by 75 basis points to a target range of 2.25% to 2.5%, unanimous decision. So Esther George refrained from dissenting as she did last time around. So it was unanimous this time, 75 basis points. The most significant tightening in a generation since the early 90s. But we can see here that in their commentary, as the stance of monetary policy tightens further, it is likely we'll need to slow the pace of increases. And I think that's why markets got so excited this week, this idea that we're slowing the pace of increases, we're getting closer to the peak in their cycle, and that's why we saw the stock market respond up, the bond market respond up, and then yields, long-term yields come down. Also telling us that they don't mind a little bit more slack in the economy. They don't mind if they break the economy a little bit. They don't mind if they create a little bit of unemployment to balance out the shortages in the labour market, saying here it's necessary to have a growth slowdown to create some slack. That is Federal Reserve Chairman Jerome Powell. What a great piece of data to come out in the same week as well. Advanced GDP in the US showing another quarter, 2 consecutive quarters now of contraction, 0.9% in the June quarter versus minus 1.6% in the March quarter. That is the technical, or that is the definition of a technical recession, I should say, those 2 consecutive quarters, although the official definition is left to the National Bureau of Economic Research in the USA, and they may not move to call it an official recession because of that strong labour market. We shall see. Certainly politicians, Biden getting up during the week, Treasury Secretary Janet Yellen getting up during the week and saying this is not a recession, don't panic. But politicians need to talk things up, not talk things down. Federal Reserve Chairman, he's in theory independent. He also said it doesn't seem like a recession just yet, but we shall see. Certainly the trend, I would suggest, is not looking too good in that regard. Now, this is probably the most important chart I'm going to show you today, but it helps you understand what is going on in global markets. Now, if you go back to the red line, which as we can see here is the 22nd of November last year. Now, that was the day Jerome Powell was reappointed as chairman of the Federal Reserve. He walked in the door an ultra dove, that is, placating markets. I'm going to keep rates low. I'm going to support markets and support the US economy, and that in turn will support markets. He got reappointed another 4 years, and all of a sudden, in that acceptance speech, turns into ultra hawk. I am going to fight inflation. Of course, that day, no coincidence, was the exact high in the NASDAQ. If you don't believe me, go look at the chart. The day he was reappointed, literally as he started speaking in his speech and changed his rhetoric, markets tanked and they fell 35% from there on the NASDAQ, and we know what happened everywhere else. So on that day, we had this very normal, we call it, quote unquote, normal looking yield curve, which has some steepness in it. So longer term yields, the price of locking in money for a long term, obviously you want to be compensated more the longer you're locking your money in. That's higher. It was about 1.55% compared to your lower rates, which were very close to zero, because obviously official rates were close to zero at the time. And then we flick forward to March, and after their meeting there, and we can see how much the interest rates had changed. The market rates have significantly moved higher, and we can see how the curve has become far flatter. So we're getting very little extra compensation the further you go out. Then we get to the blue line, which is June. Okay, very, very flat, but obviously everything's gone up. We're about 3% now. And then the current one in July, which is what we call inverted. Okay, so we have longer term rates getting priced cheaper in terms of interest rates than shorter term rates. And the expectation is therefore that rates will come down in the future. They're high at the moment, but they will come down. Why do they come down? Why do we get these inversions? Well, these inversions tend to happen before recessions. In fact, the last 9 times it's occurred, we had 9 recessions. I'm going to say 10 because this is the 10th time. And technically, if you look at those 2 quarters of consecutive decline that we got this week, you would say it has confirmed its 10th time. So what does that all mean? I know I've spent a bit more time this week than I usually do going over this stuff. I think it's important to understand this stock market rally we're having within the context of what the markets are saying about global growth going down the track. Now, 2 things can happen. What has happened in the past is that when we're in a recession, stock markets find their low and they rally because they're factoring in the stimulus on the other side that comes with the recession. The other thing is markets are too early. Markets have rallied too early. We have this recession. It gets worse than what we thought, and that's probably more like the 2007 GFC scenario where we did have significant rallies and then we sell off sharply again and make new lows. Dare I guess or suggest which scenario we're in? My gut says we're in scenario 2, not scenario 1. However, my head says follow the chart. Okay, so I'll be watching that chart very closely to tell me that the money is coming in, and the money's not worried about those things going forward. Okay, I'll let you use the data that I'm giving you today and use all the data that you can draw to make your own decision. A little bit more data on screen here. US personal expenditures and incomes. Expenditures up the top here, so what US consumers are spending from their pay packets, which are down the bottom, and that is their incomes. And we can see incomes grew by 0.6 of 1%. For the last month there, and expenditures grew 1.1%. Now, expenditures better than expected. That sounds good. You know, lots of spending, healthy economy. But when you consider that the PCE price index, so based upon our incomes and our expenditures, how much more we're paying for things, that was up 0.6% in the core. Now that strips out your volatile food and energy components, but it was up 1% on the headline. So if you knock that 1% out of these two numbers on the left to get your inflation adjusted expectations, spending only grew by 0.1%. So that is extremely anemic growth in spending, and incomes fell by 0.4%. So we're seeing this big impact that inflation is having on usable income, on our real incomes. I think that is a problem. This spike here on the core, obviously popping up from the previous 0.3% estimate, is worrying. I'm going to look over to my notes here and tell you that the core grew at 4.8%, okay, which was up from May, but still down from the peak in February. I wouldn't exactly say that's comforting. And the headline, which is what we do feel, because food prices were up 11.2%. Energy prices, this is year on year, up 43% in the USA, absolutely staggering, for 6.8% growth in a year-on-year number at the headline. So that's the one I do think you need to look at, and that is the fastest growth since 1982. So we are still very much in this environment where inflation is having a big impact on consumption and potentially the economy, and therefore the interest rate outlook. Bringing it back close to home here, we can see a similar height reading in the Australian number, but it was roughly in line with expectations, to be fair, whereas the US one was a bit hotter than expected. New dwellings up 5.6% year on year, automotive fuel up 4.2%, food up 6%. We could see those day-to-day expenses, just eroding consumer confidence there and undermining any pay rises they might be getting if they're lucky enough to get them. Trimmed mean annual inflation, which takes out some of those volatile components, up 4.6%, which is the highest since 2003, so almost 20 years, and certainly well above the RBA's 2 to 3% target, which is an average over time. RBA meeting this Tuesday, so tomorrow, to decide upon their cash rate. Market now pricing a 50% increase to 1.85% for this meeting, and then another 50 basis points in September, and then from there to get to, won't be too far for that when you think about another 3 potentially quarter point increases to get to 3% by the end of the year. But there is an outside chance they bump us up to 2% tomorrow. It's about a 65% chance priced in futures markets at the moment. We actually get to 2% tomorrow. So we will be seeing markets, no doubt. Now, no doubt swinging on the outcome. In terms of swinging, it was all upswings last week, and Australian shares 2.2% to the better on the broader index, but gold there queuing off those gains in gold prices, up 6.7%, the best performer. Materials queuing off those big gains we saw in commodities, up 5%. Energy also getting a bump on its underlying commodity as well. Suffering the sectors which have done well recently, those defensive sectors, just not as interesting or attractive when everything else is rallying. We're seeing healthcare down about 1%. Staples pretty flat there. Other interest rate sensitives like financials and property trusts also having a pretty good week. Having a look at the technical picture for the ASX 200, obviously this is Friday's close. We are open today. We did open a little bit higher this morning and just tracking a bit lower from that open. Interesting to see. That means a bit of supply coming out. Positive lead from the US, but some selling into the positivity, some taking of profits, and no surprise for me that we're doing it around the 7,000 level. I do think it'll be a psychological barrier to the upside, getting above that and closing above that. The long-term downtrend zone also coming in around that level, but obviously, you have to give total credit to the bulls and the control they had this candle, these small candles, and then the rally on this side, this amazing, what I call control pattern through here, showing that supply really is nowhere to be found at this point in time. I talked about potential supply coming this morning. Supply means black candles. And if we see the black candles in the upper shadows coming around this zone, not only will we get a pause, we could even get a pullback. Hey, if I'm wrong, we get a bunch of white candles in this zone. Hunky-dory, happy days. We're actually going to smash through that, won't we? We'll probably head into 72.89. I don't think that's what's going to happen, but watch out for the candles. You won't need me. You'll be able to do the analysis yourself and make a call. If we do get a pullback from, say, sort of 7,070.50, watching around these white candles, I mean, 6,900 may well be where it's going to happen. That is a bounce, and then we'll see where these short-term moving averages are coming up and crossing. I think you're going to get a confluence of potential demand points. Let's call it, say, 68.75 into 6,900 for the pullback case, and we're getting way ahead here, so we'll just keep an eye on the candles till we get there. Having a look at some of the technical and valuation factors for the Aussie market. This is market breadth, so what I'm doing here is I'm looking at the number of stocks trading above their respective exponential moving averages, anywhere from 1 week out to 1 year. In the bull market phase, we're in the green zone. Okay, that is tried and true over many bull market phases. We are obviously exceeding that in the short term, exhibiting just the severity of that rally. And really, it is an extraordinary rally. Let's face it, looking at something like this just confirms how amazing this rally has been. And then we do fall away from there, but it is improving. You can see from last week's yellow line to the current orange line. Once this is all back up in the green zone, the orange line is back up in the green zone, we're officially back in the bull market, almost, you could say, regardless of what the price action is doing. The breadth would support that thesis. Having a look at the sector trends, and really ups are still the safest place to be. So energy, healthcare, staples still looking very strong. We've seen improvements during the week in materials, going from the downtrend to the neutral trend, and gold getting close to switching that uptrend. I just felt wasn't quite there, so I left it with down. Otherwise, it's all short-term uptrends. We can still see some damage there in the long-term trends, reflecting, I guess, that market breadth image we just saw. I would suggest still too early in materials if you're going to pick a bottom there, but you know, it's surprised me to the upside. And I'd say still too early in financials as well. I know they're the two ones people are always asking about in terms of valuations, because we have been watching for the last few months. We've been doing these sessions. Valuations come down from their peak of around about 20. This is the ASX 200 to as low as 13 last month, and now popping back up. So what we're seeing here is that as obviously prices rally, those prices are rallying faster than expected earnings, okay, and therefore the PE is rising. Having said that, most of the sectors there are still closer to the bottom end of their range than the top end of the range. None of them are anywhere near the top end of the range, so relative basis maybe on the cheaper side than more expensive just yet, but noting we have turned the corner there. Having a look to the week ahead, we have the Reserve Bank of Australia cash rate decision. We talked about that today. Everything else is going to pale in insignificance compared to that one, but you might want to keep an eye out for the ANZ job ads coming out later on today, and retail sales maybe on Wednesday. Having a look overseas, not a huge number of data releases, but certainly some important ones, some manufacturing and services data in China and the USA, and then the big one at the end of the week there, the non-farm payrolls. We're looking for 250,000 jobs to be created in the US economy and an unemployment rate of 3.6%. And because the Fed really has pegged this labour market as the key determinant of whether it slows down or keeps going, you know, the strength in that market, we will be watching for that number very closely. You can see the previous growth number there, 372,000 jobs created, and you can see how we're coming down to 250. So any miss to the downside there, I think would I don't think it's going to help markets. I think we've gone through this phase now where weaker economic data is good news because it means the Fed's going to back off. But I think this week will show you that weaker economic data is bad news again, and maybe that also causes some of that resistance we've talked about in those charts, because we're so close. From a risk reward perspective, you've got to think, well, if you're buying now, you're buying after that huge rally, potentially close to these resistance levels, and at a point where bad news becomes bad news again. I'm just not sure if getting in now, if that balance of reward to risk is skewed in your favour anymore. Hey, with hindsight, getting in 15-20% ago at the lows, and I'm saying this with hindsight, maybe the reward to risk is there because you're buying at the bottom of the move. Now, you didn't know it was the bottom of the move, but at least it was the bottom of a move. You're not buying at the bottom of the move now. You're buying after a significant rally. So caution, I think, is the best way to go. If you want more of my analysis, tune in tomorrow. It's less about my analysis of these bigger picture things, more about my analysis of your portfolio. So bring your portfolio along, ask me about the stocks you're interested in. I'll give you my best fundamental and technical reader on those. All comers are welcome, so tell your friends to join me at 1 p.m. tomorrow. There's the link. Head to the website to find the webinars section, or I've also got a link pinned to my Twitter profile as well. You can find it there. Other than that, ThinkMarkets Australia has all the products you need to trade, or that you could ever want to trade anyway. Over 4,100 products from all over the world, including your ASX shares as well. Very competitive rates of brokerage, obviously commission free on our CFDs, but $8 flat rate for our CHESS sponsored ASX equities. 24/7 customer support, fantastic trading platforms. We've just launched a new one, incidentally. Go check that out. And all of my analysis as well. Head to thinkmarkets.com/AU. Find the account opening links there, and you could be trading in minutes. If you're watching me on YouTube, please hit the subscribe button to stay notified of all of our upcoming videos and analysis. And of course, smash the like button to let us know you love what we're doing, so we'll keep doing it. Well, that's it for me today. Hopefully you enjoyed the analysis. All the best for your trading. Until we catch up again, bye-bye for now.